You swipe your card, a soft beep, receipt prints, and somewhere in that quiet moment, money appears. Not moves, not transfers, appears. That's the uncomfortable truth most people never hear. Because the money you just spent didn't come from the government. It didn't come from the central bank. And it definitely didn't come from the pile of cash you imagine sitting in a vault. It was created right then by someone you didn't vote for. And once you see how it works, it's very hard to unsee. Right now, it feels like money is everywhere and nowhere at the same time. Prices are higher, debt is normal, cards tap faster than cash ever moved, and most of us are walking around with a mental model of money that stopped being true decades ago. That's why this matters now, because if you don't understand who creates money, you don't really understand inflation, debt, financial crises, or why the system keeps feeling fragile even when markets look calm. So let's start with a simple scene. It's trust shifting, and trust, unlike cash, can be created very quickly. This is why economies can grow fast and why they can collapse faster, because if money were physical, growth would be slow and limited. But credit-based money can expand almost without friction. That sounds powerful. It is. It's also dangerous. Here's the uncomfortable math. Banks earn interest on money they create. They don't earn interest on deposits the same way. The incentive is clear. More loans, more money, more profit. But there's a catch most people never think about. Banks create the principal. They do not create the interest, which means the system requires constant expansion. New debt to pay old interest. Growth to keep defaults manageable. When growth slows, tension builds. This is why financial crises don't look like gradual declines. They look like sudden heart attacks. 2008 wasn't caused by people missing mortgage payments. It was caused by a loss of trust in bank-created money. The moment banks stopped trusting each other, the money supply effectively froze. Central banks stepped in, not because they wanted to, but because they had to. They didn't save banks. They saved the idea that bank money is real money. And here's the irony. People blame central banks for printing money. But central banks mostly react. Commercial banks act. The hype says governments control money. The reality says private institutions create most of it. The hype says inflation is about too much cash. You walk into a store, you buy something for 5,000 rupees, you tap your card. Most people imagine this. Your bank checks your balance, sees you have enough money, moves that money to the store's bank. End of story. That feels logical. It feels safe. It feels wrong. Here's what actually happened. Your bank doesn't move existing money. It creates a new deposit out of thin air, marks your account down, marks the merchant's account up, and settles the difference later between banks. No wheelbarrows of cash, no vault doors opening, just accounting entries. And this is where things get interesting, because banks are not just middlemen. They are manufacturers. Commercial banks create the majority of the money we use, not the central bank, not the government. Globally, over 90% of money is bank-created credit. Digits on screens, promises backed by debt. Physical cash? That's a rounding error. This wasn't always the case. If you rewind a few centuries, money was simple. Gold, silver, coins you could drop on a table. Banks were storage facilities. You gave them gold. They gave you a receipt. Then someone noticed something. Most people never came back for their gold at the same time. So banks started lending out some of it, then more of it, then more than they actually had, and nothing collapsed. At first, fast forward to the 20th century. Gold standards break, currencies float, governments promise stability, central banks promise control. But quietly, the real power shifts. Because modern money isn't created when a government prints it. It's created when a bank issues a loan. When you take a loan to buy a house, the bank doesn't hand you someone else's savings. It types numbers into your account. New money exists. Debt and money are born together. This is the part that feels absurd once you see it. Every new dollar, rupee, or euro in the system starts as someone's debt. There is no pile of money waiting to be loaned out. There is only permission to create it. And that permission comes from regulation, confidence, and the belief that the system will hold. Now let's go back to that card swipe. When you tap your card, you're not spending stored value like water from a tank. You're triggering a chain of trust. Your bank trusts you to repay your debts. Other banks trust your bank. The central bank stands behind the system, promising liquidity if things go wrong. It's not money moving. The reality is about too much credit chasing too few real goods. The hype says money is neutral. The reality is that money enters the economy unevenly. When banks create money, it flows first to borrowers, asset buyers, property markets, financial markets. Prices rise there first, wages rise last. That's not a conspiracy, it's mechanics. And once you notice it, a lot of modern frustration makes sense. Housing feels unaffordable because credit flows into property faster than homes can be built. Markets feel detached from reality because money enters through financial channels. Savings feel punished because stored money loses value in a system designed to expand. None of this is accidental, and none of it is easy to change. Because if banks stopped creating money tomorrow, economies would contract violently, businesses would fail, unemployment would spike, governments would panic. The system is stable only as long as everyone believes it is. That belief is reinforced every time your card swipe works. Every beep says the system holds. For now, zoom out even further. Digital payments, instant transfers, invisible money. We're moving farther away from physical anchors and deeper into abstract trust. Central bank digital currencies, stablecoins, private payment rails, each promises efficiency, each concentrates power. The question isn't whether money will keep changing. It will. The question is who gets to create it, who benefits first, and who absorbs the risk when trust cracks. Because money isn't just a tool, it's a map of power. So next time you swipe your card, pause for half a second. Ask yourself a quiet question. If money can be created with a keystroke, if debt and currency are the same thing, and if trust is the real foundation holding it all together, what happens the day we stop believing?